that's the end of my segment. I just want to repeat, please do check out DNA Funded if you do want to expand your trading capital. It is one of the main problems for retail traders, and you can use our discount code, which is A1 Live, for 25% off. Thank you very much. I will see you tomorrow, and let's see what the speech will say. See you.
If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show.
What's happening, everybody? Happy Tuesday. Welcome back. I have some trades to get posted today. What you're seeing on the screen here, a couple levels that I'm watching for the SPX this morning. For the day's trading, we started out with a pretty wide plus or minus move. We had another large gap. So close on Friday, big gap up by like 1.2%. Very choppy price action yesterday, which wasn't a huge surprise given the blowout move on Friday. So calm market maker based price action on Monday, and then a big gap overnight with the futures down. Interestingly enough, the market is kind of holding up. I mean, it's down for the day. We're in red by 0.5%, but that is off of the like 0.8, 0.9% lows. I mean, the market was down close to 1% today. From that gap, I mean, we had a push of like 1.5%. We tested the lows from Friday, and we were sitting right here at 66.21. So, look, I think that this is still the kind of perfect weakness window. VIX at 20 plus. I mean, we had a high today around 22.93. When the VIX is above 1920, it's hard to have this positive gamma of volatility suppression in the options market, which basically means the sell the puts, sell the calls, slow melt up stuff. It's less common. So I just think right now is not a time to be super brave and start trading in the trenches with a lot of capital. I think now is the time that you take some bites, you take some nibbles. I'm doing some premium selling. I have a couple of trades I'm posting for Pulver alerts on the SPY and the QQQ for some income. And I'm going to get some trades in today. I've talked about this before, but CEF, I want to get some levels back in. We're hitting some highs once again. Here's XAU, which is spot price gold, at some fresh highs again today. Here is silver with a big indecision candle. But again, this is silly to call the top. I joined Marco there at the end. I mean, don't call the top. If anything, I'm looking to buy dips. I would not be shocked to see 10, 15, 20+% corrections that come out of nowhere. I mean, there's not really a rhyme or reason on how or why gold would correct. The only thing I can really make sense of right now would be something drastic in the dollar. So if the dollar continues to catch a bid and climb up where we get to the 100 handle on the dollar or the 101, 102 handle on the dollar, I could see that kind of stalling gold at these levels. But anyway, I'm going to go back in after exiting some positions. I'm going to get back into some dollar cost averaging. So here's a 37. I'm just write these down. I'm going to go 37, so CEF. And I've already issued Pulver alerts for GLD and SLV for similar allocations, but I think CEF and PHYS are also ways to play it. So I'm going to go CEF levels will be 37 is a small guy, 37, down here towards 35. And I'll go down to 32. And see if we ultimately come down here towards 30. Okay, so I'm going to get those trades in and ready to go. I'm just going to do a $1,000 allocation to each one. So 1,000 divided by 37. So price is there. And then quantity, I'll do 27. And then 1,000. For 35, 1,000 for 32, and 1,000 for 30, 33. Okay, so that's 4K allocation. I'm going to do $1,000 on my cash accounts and 2K on my margin account. So I'll just double those from my margin accounts. And I'm going to get those trades in and posted for Pulver Alert. So CEF ready to go. CEF, I'll go long stock. So I'm looking to buy 27 shares at $37. This should be right around $1,000, $9.99 cost. So pending order right there. Okay, and then another one. I'm going to DJ Cal this thing. 35 will be the price. Share quantity 28. For another close to $1,000. 32. Quantity 31. And 30. Quantity 33. Okay. So this one, I'm actually going, this is a margin account, so I'm gonna increase this one. So that would be, let's go. I mean, it's a margin account, so I need to double those. Sorry about that. So $37 at 54 shares. That should be 2K. There you go. And 35 for 56 shares. 2K. Got it. 31. $32 spot price for 62 shares. And last one will be $30 price at 66 shares. Okay, so that's posted. I'll get this officially in for Pulver Alerts. I'm doing these 4 levels, $2,000 margin, $1,000 cash. So my margin accounts will be all of these here. 1, 2, 3, 4, 5 there. So those are all my margin accounts. And then the remainder will be my cash accounts that I'll take $1,000 for those positions on CEF. I'm also going to do PHYS, which is trading at 31.60. PHYS, I'm looking for a pullback towards 30. And a pullback towards 28.50. I'll pull back to 27. And we'll go 25.50. Okay. So do the math on that. 2,000 will be 66. 2,000 at 28.50. 70.17. So 70 shares. 74 shares. And 78 shares. Okay. So PHYS. Long the stock. Spot price is 30. 66 shares. And 28.50 spot price at 70 shares. $27 spot price, 74 shares. And $25.50 spot price for 78 shares. Okay. So those are in. Let's go to Discord. I'm going to go find I'm just going to put this under, technically this would be stocks and options, even though these are like silver and gold trusts. I'm just going to put them under stocks and options for my trade alerts. So looking at new trades, dollar cost averaging into CEF and PHYS for gold and silver exposure. CEF, I'm adding 1K positions for cash accounts. I'm adding 2K per position for margin accounts. CEF buy levels, $37, $35, $32, and $30. PHYS buy levels, $30, $28.50, $27, and $25.50. Yes, gold and silver continue to run hot, but I'm not taking the bait and buying the highs. Pullbacks are likely, and don't be surprised to see 5 to 15% pullbacks before aggressive dip buying. All right. That trade is a fish in Pulver Alerts. Posted. Okay, good stuff. I'll do this on my own time, but I'm gonna take this out and get this spread out through all my accounts. The good thing is not a single trade is filled because they're all limit orders, but I'll get these posted for my margin and cash accounts. Let's go back to the markets. Let's take a look at everything today. Here is today's heat map. We have about 49% of stocks declining, yet from the bottom today, the markets are up off the lows. 47% of stocks advancing, 49 declining. Some big names in the red today. Big drops in NVIDIA, Tesla, Oracle down. So, those are some pretty big names in large market caps. You see a lot of green, though. Defensives, I think I lost my stock on Walmart this last week, which is a bummer. I meant to roll that on Friday, and I was out of the office in the afternoon, but I think it got called away at 100. Let me double check that here. So positions. Yep. So my Walmart shares got called away. My break even was pretty low, though. I had break evens at like 75 and 81. So I got it called away anywhere between like 200 or I guess $20 a share, $25 a share on Walmart. So could be worse. Got some buying power back. That's fine. But yeah, those shares got called away. Just looking at consumer defensives. Chart alarm is going off. We're at 36. I just hit my 35. Dadgummit. All right. So that's one of my line in the sands for the day. Hopefully we will see price. This is where I want price to be back below today. So if we come back and maybe test, like today's price action might be test the low from Monday and fill the gap, and then possibly test, the level from last night's close and test the gap. But I'm obviously wanting to see price if it, test the gap today to hopefully reject and have a low, high, and close. Ideally, I'd like to see price less than 66.35 today for some profit in SPX. But the market is still working its way up from the bottom. I mean, we've had a pretty big swing today. Market's already swung up about 1.26. VIX was up to maybe 1.3, 1.4. So if market makers do their job, we shouldn't see price going too much higher than maybe 1.3%. So maybe like a 66.40, 66.41 high today. Again, that's if the VIX that opened up around like 21, 22 is going to kind of maintain that market maker type move on the day. So we'll see. But I've got two levels. I want to see if prices below this line, above this line, below this line, above this line. And ideally, this is my zone. So if I'm in here If I'm in here for the day, then I've got 2 for 2 on the daily winners for SPX. Okay. All right. I did close out. I don't know if I made this an official trade. I know Nick and I talked about this. I did go out to November. I did close out a hedge on the VIX. I closed out my near-term one. So I closed out the November expiration for some profit. This trade was a VIX November expiration. I paid $2.81 debit, and I closed today. Closed for $4.20 credit. So not a huge win, but the next trade that I have is a VIX April expiration. That is, if we have another flush to the upside, if this, back and forth with China, US does not, I guess, completely get resolved, or there's more noise to it, I think the market is not done going down. I think this is kind of the test to see, if we don't have something positive coming out of US and China. And again, it's like, we're not hitting the freaking 50-day. Like, this is driving me nuts, man. Like, we didn't hit the 50-day on the SPX. We have not hit the 50-day on the SPY. We have not hit the 50-day on the QQQ. The only thing we did hit was futures. So we did hit the futures 50-day on Friday when the market dumped and sold off after hours. But, the Dow's hit the 50. We're bouncing off of that on the Dow. The Russell, just shy of it. So, I mean, is this it, man? Like, is this it? Market just pulls back and it's one day sell off and you got to buy the dip Fridays. VIX is up 31%. The market's down 3%. You got to buy the dip on Friday at close in order to get paid any money. It's unbelievable. So I hope that's not it. I hope there's actually more to this complexity of like, hey, how about the market doesn't just go immediately up? I mean, we're in a negative gamma environment. And I still think there's a lot of resistance right here, right around like 65. If we stay, less than 40 today, less than 35 today, less than 65 today, we're still in a negative gamma environment. Okay. So we'll see how the day plays out, but it's interesting to see that there's more declining stocks than advancing. And there's also, some pretty big, large market cap numbers that are red. Looking at the heat map here, NVIDIA, Broadcom, these are top 10 stocks, Tesla, top 10 stocks, Amazon, nothing really shining for the Mag7. And it's not like it's a broader, like, oh, it's a dip in Mag7, it's a dip in tech, but everything else is green. It's not. Right? I mean, we're at 49% advancing. So it's not like we have this like huge broad market rally today. So anyway, I'll keep monitoring. All right, let's go elsewhere. Let's go dollar index. Dollar index catching a bid, has been bullish since the bottom in FOMC. That was September 17th. That was a great spot to be long the dollar. I called that level. I said, watch out for that double bottom, that sweep of the lows. I think that's a support level, and it was. So if you sold the euro dollar, what a great spot. The two best trades really: sell the euro dollar, sell the pound dollar. The New Zealand dollar has been down pretty consistently, but the Aussie dollar has been choppy. Dollar Swiss has been up off the bottoms pretty nicely. Dollar yen, it wasn't just all the dollars doing. We had that huge move in the yen that still hasn't filled the gap to my knowledge. So that dollar yen is still crazy up compared to the gap open. I do think this gap gets filled, and it's excitingly enough about 440 pips away. So, it's certainly risky to say like, oh, we're going to fill the gap, and you got to kind of dollar cost average into that level. However, if you trade small enough, it wouldn't be surprising if you stacked up some trades. If you were to go, I don't know, and maybe to be safe, it's like you do a sell stop and a sell stop and a sell stop and a sell stop, and your stop loss is if price goes down this way to fill that gap, you just put a stop loss above and then trail it and trim the risk a little bit. But if we get into this open space, I think this gap gets filled for some gains. So there's a couple ways that we could play it on the gap fill. Ideally, I wouldn't mind have this thing coming up back up to retest the highs, maybe get a little bit higher towards like 154, 155, and then sell it here with that gap as a target. But obviously the yen is very slippery and kind of always is and probably always will be. But anyway, I'm curious when that gap gets filled. I'll set a chart alarm based on that gap up like 140. We'll go 147.50. 147.50, and we'll put a Japan PM surprise gap filled. See how long that takes. Okay, so dollar index catching a bit of a bid above this rising wedge. There's room to get up to 100, 101, 102. I'm still looking to short the dollar. This is probably one of the bigger moves that could surprise the markets in 2025. One of the outliers would be the dollar just catches a bid. If it's an aggressive move where it's very one-sided for the next, I don't know, maybe 30, 60 days, if the dollar goes up to 101 or 102, that might be enough to move. You know, we've caught a bid on the bond market. It's not quite at fresh highs yet. Bonds futures, I think, tested highs this morning. Yep, tested highs but failed. Yields tested lows, but just kind of holding firm off those levels. And what else? Move index for bond volatility. This is kind of like the VIX of the bond market. It is up. So we're getting some elevated volatility there. Let's go individual currency pairs. Aussie CAD, some overbought conditions. I still like symmetry towards 9,400. It's around 9,375 would be my symmetry move. I still like that trade a lot, actually. And now I'm getting prices. This is way above the VIX level today. Market's up 1.4%. Market makers should be containing it around 1.3. So we're already letting it run loose. I swear to you, if I freaking lose like this trade and this trade today, I'm gonna be so pissed. Like even in a high VIX environment, just like there's risk every single day. 0DT is like so freaking squirmy. But anyway, I've got 360 risk and I've got $4 risk on the two trades. I'm hoping the market is not just up for the day and done for the day. I mean, I like some volatility. Let's actually, you know, hit some levels, have a guardrail, maybe come back down. We'll see. But I thought this was way out of the money. You know, VIX box highs and lows, ridiculous. If we end up exceeding my VIX box for the day. But whatever, man, you just trade and define some risk and hope you don't get burned. But we'll see. Day isn't done. I'm hoping the market responds to this. If we test the gap right here, you know, mission accomplished. Let's see if the bears can come back in and take it back down. I'll set this chart alarm. I'll go to 6,600, I guess, right now. See if we come back to 6,600. Keep an eye on this. All right. So Aussie CAD still looking for a move higher. I mean, wave count wise, 1, 2, 3, 4, 5. See if we can finish this move around 9,350 to 9,400. Let's go other currency pairs. I'll just move through all our currencies right now. Aussie Swiss. Pretty good intermediate support around 51.70. So these lows at 51.70, this major low at 5,000. You know, I'm just kind of in this like positive swap trade, but I'm looking to see if this is actually a bottom type move. Is this a low to a high? Is this the higher low that's consolidating? Are we going to make a break for that third wave? If this is 1, 2, 3, I'm looking for symmetry to be up to like 55 to 5,600. But if it breaks this low, okay, if it breaks this low, then more than likely we can come back down to what? 5,000. So, I mean, if this is a bottom here, I still like this as support. We go back up to the center high. This would be support. This would be the center high resistance. We break and go through that. You double that move. And now we have roughly a, 300 pip move here and a 300 pip move projected up. That gets us to about 5,600. But it's important, obviously, that we hold this support. Okay. So either this is holding support for a third wave, or this is going to come back down and test the lows at 5,000 and then possibly double bottom into a, 600 pip move. But I think that's a good trade to be kind of leveling into. Very, very small on Aussie Swiss. Aussie yen, super noisy. Aussie New Zealand. I actually like this trade. If you wanted to short Aussie New Zealand, I think this is a pretty good spot to get some low risk. Short it. I'm going to take this trade. I'm going to go short at 1350 and short it again at 1440. I'm just going to short the high. Stop loss will be above the 1500 handle. I'm going to go like 1550 stop loss. Okay. So I'm going to go sell. See if I can go. Let me sell. Hang on. Let me get my MT4. So I'm going to sell at 1351. So sell at 1.1351. Filled. Then I'll do a limit order, a limit sell at 1.14. Highs around 1445. I'll do 1440. Okay. Stop loss at 1.1550. Take profit would be safely back to 1.1180, and possibly back down to like 1.1. Take profit number 1. And take profit number 2. If you want to hold this a little bit longer, 1.1020, just around the round number at 1.10. Okay, I'm going to put this trade in for Pulver alerts right now. This is going to be in FOREX. New trade, Aussie, New Zealand. Sell 1.1351. Filled at market. Pending sell at 1.1440. Limit sell. Take profit number 1, 1.1180. Take profit number 2 at 1.1020. Okay, so let me put in this as a short. Short here, stop loss around 1550. If we get both of these levels filled, there's my 1440 high. Target 1 is this past level, so right in here. Okay. And I will copy link. Post that chart. Okay. Pulver alert sent on Aussie, New Zealand. Powell today at 12. Is it 12 p.m. or 12:20 or 12:30? What's he on the calendar for? Today at 12:20 p.m. Economic outlook, monetary policy in Philly, business economics annual meeting. He might have some headlines popping up here in the next, 20, 30 minutes or so. It might be something very scripted. Financialjuice.com. Let's find out. So nothing yet. But let's see what the ultimate, day's price action gives us. Okay, next up, Aussie dollar. I still like Aussie dollar long, gold, commodities, China. I know there's a little risk here. We had a sell off that, the dollar could get a little bit stronger in the near term. But if you're looking at dollar cost averaging, this little pullback on the Aussie dollar, I think this is still the target. I think Aussie dollar gets to 68.50, 6,900. So if you're, buying small, even down here, stop loss wise, I don't see price necessarily coming all the way back down to those lows. I could see us catching a decent bid in here and still going up to 68.50, 6,900 for profit. CAD Swiss, I'm patiently waiting for a bottom. Okay. And again, I'm not saying I'm waiting I'm in the trade. I'm long CAD Swiss, but I'm looking to see when price will actually, start to breach for the first time in a long time some of these moving averages. And all I'm looking for is a bottoming pattern. So do we have something like a crown pattern, something like a trend line break, something like a falling wedge, anything that gives me a little bit more evidence that we're going to stop declining? Okay. Because there's nothing left. Like on the left side of the chart, this thing is at the lowest lows it's ever had. So we're just in no man's land, and it's hard to say like, oh, the bottom has to be this. The bottom is wherever the heck it's going to be. I'm just looking at the fact this thing has been in a downtrend since May of 2022. We've been in a 3-year downtrend on a currency pair, and usually currencies aren't like that. So, it doesn't mean anything. It is positive swap to hold CAD Swiss. If we get another recovery, a robust rebound in energy, and maybe oil goes up, then the CAD can get a benefit there. But until I have like a decent pricing pattern, I'm just going to be stuck with tiny little positions, just kind of waiting this thing out, which has grown incredibly frustrating the last couple of years of holding. It's positive swap, sure. A whopping, 3 to 4% return on my holding positions while I'm nursing some drawdowns. But I haven't gotten heavy on really any of these positions. I'm just kind of waiting it out for right now. CAD yen, super messy. I would stay out of the CAD yen. Swiss yen, as I mentioned the last couple of weeks, I like Swiss yen a lot as far as looking at an opportunity to short. this low. We haven't spent any time on the right-hand side of the trend line. Don't call the top, okay? If this thing starts to sell off and we fill this gap, another one that looks pretty attractive for a gap fill. But if we fill this gap, that's a huge checkpoint. If we take out this low or this low, that's a huge checkpoint. Now we can start to see the semblance of a topping pattern. Now we can get a swing trade and we can measure some moves, right? So just a little bit more confirmation makes all the difference in the world. If it doesn't take out these lows, do not short this thing. If it rolls over on the right-hand side of the trend line, we could have thousands of pips worth of profit potential, but I'm not going to be calling this top unless I have a price pattern that I can trade. Same thing with the Euro Yen. Euro Aussie, totally choppy. Euro CAD, like a slow, grindy trend. I don't love it. I mean, you're right now, you're buying the dips. I mean, if you're buying dips on the 21 and 50 day, it's been trending for the last couple of months. I don't see this. Don't short it. I mean, there's no resistance, so I wouldn't short it. Look left on the chart. It's up above all this major resistance. We're still probably finishing a big move here that barely pulled back. This is kind of unusual for the Euro CAD. This move having a pullback of 38%. We're almost up to the 618. I mean, you might get a pullback here. 165, if you're looking like 164.50, 165 could be a pullback zone. So if we hit this resistance, maybe that 165 handle gives you like a wave 4 pullback. Wave 4s are not my favorite trade, by the way. Wave 4s are terrible trades. If you want to top out, wave 4 is a terrible trade. If you want to top, you want to short a wave 5. So if this is ultimately a 1, 2, 3, 4 would be a pause. 5 would be way the heck up here. That's the short that you want. So, I mean, I'm not saying that we can't have like a few hundred pip retracement from that 165 handle, but it's just much less cooperative versus like a 5-wave short means you get a 1, 2, 3 correction. 4 waves is just like this pause in the market. So I'd be careful on that. Okay. So long story short, if you're bullish, maybe protect some profit in the 64.50 to 65, waiting for a bit more of dips and pullbacks. This also offers some really good dynamic support. If it hits 65 and pulls back, this is really good support. It really is. So dynamic support and all these moving averages to continue this move. I mean, if we can buy it like 160 and the thing's going to trend up to 170, that's a good trade. Okay, Euro Swiss, pretty strong support around the 92 handle. I'm long from there as well as other positions. I never took profit back here. I thought we hit parity. So I'm just dollar cost averaging in. I've got a break even around like 93, 9,400. So a lot of positions over the last couple of years, just kind of slowly waiting. If we do end up holding these lows, then maybe we break some highs, measure this thing back up to a range, get back to some resistance level. What up, Nick?
Hey, Chris, how are you, man?
Good, man. How are you?
Hanging in there. It's
hanging in there.
Crazy time in markets, that's for sure.
Yeah. We'll see, man. VIX is retreating a decent amount today. I mean, VIX is still up 5% because it was up all morning, but it's been retreating pretty hard. VIX is down from the highs about 13%. I'm surprised to see the market up as hard as it is with only about half the stock market advancing. It's really not like a big rally today. It's getting there.
You got your heat map there. Did you do anything with your VIX? I closed some of my VIX long calls. Took some profits on there. Did you do the same?
I closed out the Novembers. I closed out November VIX, but I'm still leaving the I'm leaving the Aprils. So here's what I did on the VIX. Oops, that's SPX. Let's go. So VIX, I closed out November, and I still have April running. Okay. So I'm out to April just in case there's another flare up in the VIX. Maybe we get to 30 plus. If I look at the analysis on this one, the thing is there's time. This one, if we have VIX at 30, I'm up $700 or $800 on this trade. VIX at 22, 23, it's like, yeah, I need the VIX to elevate. But the November one, I just thought if it's one of those situations where this market is just so resilient and so bullish that you've got Trump that tweets on Friday and then backpedals on Sunday, Monday, the market just doesn't care as much. It doesn't care enough. It's like the sentiment completely 180'd from Friday to Monday. Futures is up, huge gap up. It's like clearly it just like calmed the nerves of like this, this potential like trade war sell off.
Well, and the thing is, Chris, we've been talking about this, which is, look, I think that you could have some troubles in 2026. I think that there is I think the calendar favors the bulls until the end of the year, but then once you get in 2026, you lose some of the same advantages that we've had in this momentum the last few years. And specifically, what I'm referring to is the catch-up trade after a good year. Is a real thing. You have a lot of investors, a lot of portfolio managers who are, of course, managing tons of money, who have probably looked at this year and they looked at April and they said April really just was annoying, right? It caused a lot of people to get out of the market to de-risk because that's what they have to do as portfolio managers. And then the market just did a V-shaped, no pullback recovery for most of this year. And during that circumstance, which we're looking at a 10-year average seasonality of the S&P 500, we typically see strength into the end of the year. In the last 10 years, that has been very much the case because you've had a really good 10-year period. So there's been a lot of chase at the end of the year. Could we get an anomaly year? Could we get something different like 2018? Of course we could. We don't know for sure. But I do think that in terms of the calendar at least favors the bulls for now. You've had a good year up to now. You could have stabilizing. Maybe we just go sideways for the rest of the year. I just think that there's, clearly we saw two things I got out of it. Number one, this market is so sensitive to a shock. If you do have a shock that doesn't just get washed away by Monday, you could get a serious market correction very, very quickly. The other thing is that we found out that, what we kind of already knew, which is Trump absolutely does not want to see the stock market go down, and neither does President Xi. So It's like the first drop of the market, they both, panic tweeted or panic posted saying, things are going to be fine.
Yeah. I mean, Hen saying, by the way, it's like HSI for China is down 7.5%. Imagine if we had that in the US, Nick, we were down 2.5% on Friday, right? It's like top to bottom was like the candle itself was like a 3.2, 3.3% candle, but the actual day itself was like a 2.6% sell-off. The HSI is down freaking 7.5%. If the US had a 7.5% move in the last week, it's like, it wouldn't be abnormal to have that as a correction. I think that's a normal correction. 5%, 6%, 7%, totally fine. Is President Xi watching the markets? Are we going to, tank the stock market for China? Probably not, but it's most likely in their best interest that they keep things going. There's more fiscal policy on both sides. China's got fiscal policy. US has fiscal policy. It's just, to me, it was ridiculous what happened from Friday to Sunday. It was just like,
crazy.
why is that how it has to play out? I don't know, but it proves how noisy and how sensitive this market is and how overreactive it can be. Did you, I think you messaged me offline. Did you do anything on Friday? Did you actually buy a dip at the close? I was so angry I couldn't even get a dip.
Yeah, I bought a little bit of Qs. I bought a little bit of XLY.
Okay.
Mostly a contrarian thing. I looked at the put to call ratio. It was going crazy on Friday.
Yep.
Here's the thing. If the market keeps going down, I'm happy. If the market goes up, I took some trades. If the market keeps going down, I think there's an opportunity to build some bigger positions and stuff that I like for the longer term. We know how to be constructive with a good dip in the market.
Right.
So I'd love to see further downside if it happens, but I've also taken some trades because, again, I think you had such a shock. And on Friday, I took the long, not because I claimed to know what Trump was going to say over the weekend. That's ridiculous. But rather because sentiment got so extreme all of a sudden. Everybody panic sold ran to the exit. And I felt like if you get even a little bit of step back over the weekend, you're going to get a sharp rally. And we did get that. So I was right in the sense. Now, is this a prolonged back to the highs, all good from here? We'll see. I think, you're seeing volatility even today. Take a look at the S&P 500 intraday. You had these kinds of moves we have not seen in a while. Just goes to show volatility typically happens in clusters, right? So when you get volatility spikes, it typically stays where it's at for at least a minute there. So we had an intraday move of 1.5%. Now back in April, that was nothing, but in recent times, that's a move.
Right. Yeah. I'm wondering what the VIX. I mean, the VIX is this huge anomaly in 2025. We've had completely suppressed VIX. It's been hard to get a flare up. When it has flared up, it's been completely squashed. We're still at 20, and I think that the current shutdown extending into 3 weeks has a little bit more to do with that. Why it's slightly elevated. It was very odd last week to see the last couple of weeks really that the markets were advancing, just barely inching out to those all-time highs, and the VIX was around like 16, 17. So it's like there was a complete disconnect in correlation between, usually if the VIX is up, S&P is down, right? And it wasn't the case. Like S&P was just trying to notch out new highs and the VIX was still elevated. So that little flush on Friday was not a surprise, just to have like all the stuff kind of coming to a head. But also we're still look at like, there's like a blow off top in gold still, silver. Like I said, if you saw the segment when I first jumped on, I put in dollar cost average positions on CEF and PHYS. I want to be in more gold and silver. I want to get that allocation back to like a 5 or 10% stake between GLD, SLV, CEF, PHYS. It's probably going to be closer to like 10, 15% allocation. But I refuse to buy these highs. I've got puts, I've got ratio spreads, I've got income trades on them, but I'm not going to buy these highs and chase this thing. I saw that Peter Schiff is on there talking about the short squeeze is just underway. It's like, please, because of that type of headline, please go down. Like just pull back, and the charts look ridiculous. So, I mean, if we look at gold at fresh highs, I mean, this one here, Nick, is absolutely crazy. I mean, we're up 50+% for the year. In just the last 2 months, man, we're up 26% on gold. So
yeah, I mean, it's
gangbusters.
And look at like, scroll your chart back to like the 1970s, 1980s. You had these melt ups, and we don't know where the top is. And like we could see another 20% on gold. It's not out of the question. But you also can see, historically speaking, when you get these melt ups, what typically happens is you do go into excitement. Most of the gains happen all at once, and then you get prolonged periods of chop and consolidation. So, I mean, I'll never forget this, Chris. In 2020, I had a good friend of mine, love him, but he's not a trader or an investor. Ran down, we were hanging out on a dock somewhere at the lake, and comes down to the dock. He's like, "Man, you need to be buying gold." This was 2020, when 2020 gold was going crazy to the upside, and everybody was talking about gold. I mean, that was literally like right here. It was summer months, 2020. And sure enough, that was like right at the top. And so it was just a good lesson, like an anecdotal experience where it's like, when the average person is just rushing in and chasing gold and stocks, tech stocks, Nvidia, whatever, name your pick, you just have to be careful. It is a real indicator, I'm pretty sure. Another interesting story is when I was in college, 2017, I went to a Panera Bread. I was going to study somewhere. This was like end of college for me, and I walked into somewhere, and there was a bunch of dudes crowded around a laptop screen talking about Bitcoin, chasing it, and they were literally buying it. It was like right within a week or two of the top. I should have shorted by the time I got home.
2017. That was what was that? What was that big short? Was that the run from like 20K down to like 3,500 again?
That sounds right. Yeah. I mean, it completely cratered. Yeah, it was like right over here. It was end of year. It was cold out, so it must have been like right around here. So I mean, it was
that would have been the invention of the CME created the futures market. I think it was December 2017. Because I was in Florida. Yep. I was in Florida, and I remember looking at like that run. It was like 4 or 5K or 7K in like a week.
Exactly.
And I wasn't in Bitcoin, but when we got that pullback, I just did some technicals, and once we hit 20K. And I don't know what it is about the time, but like everyone is shouting 20K. And all of a sudden there's futures market 20K. It didn't even hit 20K exactly. It was right at it, like 1999 or something. And then we dropped down to like 3,000. So that's when I started participating in 2018, when it was down, 70, 80%. So I've had a pretty good entry on Bitcoin. I've let it go a couple of times. I put it back in, maintained a stake. It's just, the fun part is you're playing with house money, but it's become a pretty big chunk of house money at this point. After, you start out with like 5 or 10K in it, and it's 10x. It's like, it's hard to argue with. Like, it becomes real capital that you want to make sure you can take care of and preserve,
I think what also we found, Chris, on the Friday activity, what that told me, or showed me at least, is there is leverage in this game. There's a lot of leverage. Private equity, tons of leverage. Cryptocurrency world, lot of leverage. I mean, I know we've seen this stat float around everywhere, but we saw a record loss in accounts in the crypto world. There was like 100, there was some like 1.6, some number of accounts that got liquidated on that Friday move. And you know what's kind of embarrassing about that? You're talking about a small drawdown for Bitcoin. It's just that there's so much leverage, there's so much hype out there for crypto, for hot stocks, etc. That one jolty move like that blew a bunch of people up, because in the crypto world, it's very common to use a bunch of leverage. Just an interesting kind of sign of the times is it's hard because you look at that and you say, okay, that's got to be near a top, right? Well, that can go on for a little bit. You can have people, chase back in. In fact, we talked about right before all the sell-off took place, the brief sell-off. We're hoping that you would get these deleveraging pullbacks. They are good for market sustainability. So maybe we have a little bit more to work off. We'll see.
I hope so, man. I mean, price action today, I would hope that we, let's just zoom out here for a sec. I mean, if we use, and also I will say one more thing on Friday. This isn't the first time in 2025 that we've seen Trump test the waters on what he can say in the public format and see how the market reacts. Hey, I'm going to fire Powell. Market reacts. Hey, trade war this. Hey, escalated tariffs this. Market reacts. Whatever. And there's plenty of examples, but it was a big one, and the market heard it on Friday loud and clear. The market dumped. Looking at that in one day, it's funny how now all of a sudden it's like, don't worry about China. Scott Bessent's like now talking about everything's good in China. We're going to talk more. President Xi and Trump can meet us very soon in South Korea. But technically, one thing I did look at is we are breaking a trend line that we haven't seen broken since May of this year. And this is going back. Here's a 30-minute chart, pretty clean look at it. Again, this doesn't mean this is the downtrend. It's just the structure in my world from this low being taken out from Friday's close, that we go break the trend line, retest. We tested the lows again today, but I think there is some more downside. I was hoping that this week's expiration would actually mean a little bit more, being that it's like a 300 billion nominal expiration for the options market. It's a big monthly for October 17th. But breaking this trend line, if we retest and fail, and we do have some fresh lows, look, there's a low to go after, There's all sorts of dynamic moving averages out here in the higher time frame. There's previous all-time highs. And one could look at this as it's a healthy thing. It's a healthy thing for this market to keep going higher. You should want a pullback. My least favorite market is this. Every freaking grind, every single week, it won't stop going up, and it just doesn't give you anything. Right. I don't think 1% pullbacks are buying the dip, Nick. I'm sorry, but it's just not a pullback to me. So
you got to be real careful with it, because it's like, that grind, we saw that in 2017, then 2018 happened. Like low volatility period turn into high volatility environments, right? So it's just something to think about. So, Chris, we're about to pull up Powell. He's about to speak here. If you want to stick around, feel free, but I'm just going to kind of go quiet and listen. If you need to bounce, all good. It's good.
Okay. I'm good for like another 12 minutes. Well, I'll tune in. I'm just looking here. Pull up the conference. Let's see what he says. He's due to like actually speak in a couple minutes, right?
He is standing at the podium. I've got it pulled up here. But yeah, I'm just going to just kind of stay quiet and listen. All good if you want to bounce and chill out, or
I'll stick around for a few minutes. Yeah, I'll peacefully just let myself out of the room.
Okay, sounds good.
Thanks, man.
Okay, I think you guys should be able to hear it on my screen if we switch over. Let's just double check.
Thank you, Emily. And thanks to the National Association for Business Economics for the Adam Smith Award. It, for me, is an unexpected honor just to be mentioned alongside many of your past recipients, including particularly my predecessors, Janet Yellen and Ben Bernanke. So thank you very much for this recognition. I will say on a more personal note, I have greatly enjoyed my regular visits to your annual meeting and your conferences. It's really been my favorite venue all these years. It's a place. This is a place where we can talk about economic issues and not worry that someone's eyes might glaze over. I also appreciate the warm welcome I've always received here. And putting Fed staff aside for a minute, I can't think of a more lovable group of econ nerds anywhere. So thank you again for this prestigious award. And for the opportunity to speak to you here today. So, as we all know, monetary policy is more effective when the public understands what the Federal Reserve does and why. With that in mind, I hope to enhance understanding of one of the more arcane and technical aspects of monetary policy, the Federal Reserve's balance sheet. A colleague recently compared this topic to a trip to the dentist, but I found that comparison somewhat unfair to dentists. So today I'll discuss the essential role that our balance sheet played during the pandemic, along with some lessons learned. I'll then review our ample reserves implementation framework and the progress we've made toward normalizing the size of our balance sheet. And I'll conclude with some brief remarks on the economic outlook. So, one of the primary purposes of a central bank is to provide the monetary foundation for the financial system and the broader economy. This foundation is made of central bank liabilities. On the Fed's balance sheet, the liability side of the ledger totaled $6.5 trillion as of October 8, and three categories account for roughly 95% of the total. First, Federal Reserve notes, that is physical currency, totaled $2.4 trillion. Second, reserves, funds held by depository institutions at Federal Reserve banks, totaled $3 trillion. These deposits allow commercial banks to make and receive payments and meet regulatory requirements. Reserves are the safest and most liquid asset in the financial system, and only the Fed can create them. The adequate provision of reserves is essential to the safety and soundness of our banking system, the resilience and efficiency of our payment system, and ultimately the stability of our economy. Third is the Treasury General Account, or TGA, currently at about $800 billion, which is essentially the checking account for the federal government. When the Treasury makes or receives payments, those flows affect dollar for dollar the supply of reserves or other liabilities in the system. The asset side of our ledger consists almost entirely of securities, including $4.2 trillion of U.S. Treasury securities and $2.1 trillion of government-guaranteed agency mortgage-backed securities, or MBS. When we add reserves to the system, we generally do so by purchasing Treasury securities in the open market and crediting the reserve accounts of the banks involved in the transaction with the seller. This process effectively transforms securities held by the public into reserves, but does not change the total amount of government liabilities held by the public. So, the Fed's balance sheet serves as a critical policy tool, especially when the policy rate is constrained by the effective lower bound, or ELB. When COVID-19 struck in March 2020, the economy came to a near standstill and financial markets seized up, threatening to transform a public health crisis into a severe, prolonged economic downturn. In response, we established a number of emergency liquidity facilities. Those programs, supported at the time by Congress and the administration, provided critical support to markets and were remarkably effective in restoring confidence and stability. At their peak in July 2020, loans from these facilities totaled just over $200 billion. Most of these loans with conditions stabilized. That's normally the deepest and most liquid market in the world, and the bedrock of the global financial system was under extraordinary pressure and on the verge of collapse. We used large-scale purchases of securities to restore functionality to the Treasury market. Faced with unprecedented market dysfunction, the Fed purchased Treasury and agency securities at an extraordinary pace in March and April of 2020. These purchases supported the flow of credit to households and businesses and fostered more accommodative financial conditions to support the recovery of the economy when it ultimately came. This source of policy accommodation was particularly important as we had already lowered the federal funds rate close to zero and expected that it would remain there for some time. By June 2020, we slowed our purchase pace to a still substantial $120 billion per month. And in December of 2020, as the economic outlook remained highly uncertain, the FOMC said that we expected to maintain that pace of purchases until substantial further progress has been made toward the committee's maximum employment and price stability goals. That guidance provided assurance that the Fed would not prematurely withdraw support while the economic recovery remained fragile amid unprecedented conditions. And we maintained that pace of asset purchases through October 2021. By then, it had become apparent that elevated inflation was not likely to go away without a strong monetary response. At our meeting in November 2021, we announced a phase out of our purchases. And at our next meeting in December, we doubled the pace of that taper and said that asset purchases would conclude by mid-March of 2022. Over the entire period of purchases, our securities holdings increased by $4.6 trillion. So, A number of observers have raised questions, fairly enough, about the size and composition of asset purchases during the pandemic recovery. Throughout 2020 and 21, the economy continued to face significant challenges as successive waves of COVID caused widespread disruption and loss. During that tumultuous period, we continued to purchase in order to avoid a sharp, unwelcome tightening of financial conditions at a time when the economy still appeared to be highly vulnerable. Our thinking was informed by recent episodes in which signals about reducing the balance sheet had triggered significant tightening in financial conditions, and we were thinking of the events of December 2018, as well as the 2013 taper tantrum. Regarding the composition of our purchases, some have questioned the inclusion of agency MBS purchases given the strong housing market during the pandemic recovery. Outside of purchases aimed specifically at market functioning, MBS purchases are primarily intended, like our purchases of Treasury securities, to ease broader financial conditions when the policy rate is constrained by the effective lower bound. The extent to which these MBS purchases disproportionately affected housing market conditions during that period is challenging to determine. Many factors affect the mortgage market, and many factors beyond the mortgage market affect supply and demand in the broader housing market. With the clarity of hindsight, we could have, and perhaps should have, stopped asset purchases sooner. Our real-time decisions were intended to serve as insurance against downside risks. We knew that we could unwind purchases relatively quickly once we ended them, which is exactly what we did. Research and experience tell us that asset purchases affect the economy through expectations regarding the future size and duration of our balance sheet, so that when we announced our taper, market participants began pricing in its effects, pulling forward the tightening in financial conditions. Stopping sooner could have made some difference, but not likely enough to fundamentally alter the trajectory of the economy. Nonetheless, our experience since 2020 does suggest that we can be more nimble in our use of the balance sheet and more confident that our communications will foster appropriate expectations among market participants, given their growing experience with these tools. Some have also argued that we could have better explained the purpose of asset purchases in real time. There's always room for improved communication, but I believe our statements were reasonably clear about our objectives, which were to support and then sustain smooth market functioning and to help foster accommodative financial conditions. Over time, the relative importance of those objectives evolved with economic conditions, but the objectives were never in conflict. So at the time, this issue appeared to be a distinction without much of a difference. That's not always the case, of course. For example, the March 2023 banking stress led to a sizable increase in our balance sheet through lending operations. We clearly differentiated these financial stability operations from our monetary policy stance. Indeed, we continued to raise the policy rate through that time. Turning to my second topic, our ample reserves regime has proven highly effective, delivering good control of our policy rate across a wide range of challenging economic conditions while promoting financial stability and supporting a resilient payment system. In this framework, an ample supply of reserves ensures adequate liquidity in the banking system, and control of our policy rate is achieved through the setting of our administered rates, interest on reserve balances, and the overnight repurchase rate. Reverse repo rate, rather. This approach allows us to maintain rate control independently of the size of our balance sheet. And that's important given large unpredictable swings in liquidity demand from the private sector and significant fluctuations in the autonomous factors affecting reserve supply, such as the TGA. This framework has proved resilient whether the balance sheet is shrinking or growing. Since June 2022, we've reduced the size of our balance sheet by $2.2 trillion, from 35% to just under 22% of GDP, while maintaining effective interest rate control. Our long-stated plan is to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserves conditions. We may approach that point in coming months, and we are closely monitoring a wide range of indicators to inform this decision. Some signs have begun to emerge that liquidity conditions are gradually tightening, including a general firming of repo rates, along with more noticeable but temporary pressures on selected dates. The committee's plans lay out a deliberately cautious approach to avoid the kind of money market strains experienced in September 2019. Moreover, the tools of our implementation framework, including the standing repo facility and the discount window, will help contain funding pressures and keep the federal funds rate within our target range through this transition to lower reserve levels. Normalizing the size of our balance sheet does not mean going back to the balance sheet we had before the pandemic. In the longer run, the size of our balance sheet is determined by the public's demand for our liabilities rather than by our pandemic-related asset purchases. Non-reserve liabilities currently stand about $1.1 trillion higher than just prior to the pandemic, thus requiring that our securities holdings be equally higher. Demand for reserves has risen as well, in part reflecting the growth of the banking system and the overall economy. Regarding the composition of our securities portfolio, relative to the outstanding universe of Treasury securities, our portfolio is currently overweight longer-term securities and underweight shorter-term securities. The longer-run composition will be a topic of committee discussion. Transition to our desired composition will occur gradually and predictably, giving market participants time to adjust and minimizing the risk of market disruption. Consistent with our longstanding guidance, we aim for a portfolio consisting primarily of Treasury securities over the longer run. Some have questioned whether the interest we pay on reserves is costly to taxpayers. In fact, that is not the case. The Fed earns interest income from Treasury securities that back reserves. Most of the time, our interest earnings from Treasury holdings more than cover the interest paid on reserves, generating significant remittances to the Treasury. By law, we remit all profits to the Treasury after covering expenses. And since 2008, even after accounting for the recent period of negative net income, our total remittances to Treasury have totaled more than $900 billion. While our net interest income has temporarily been negative due to the rapid rise in policy rates to control inflation, this is highly unusual. Our net income will soon turn positive again, as it typically has been throughout our history. Of course, having negative net income has no bearing at all on our ability to conduct monetary policy or meet our financial obligations. If our ability to pay interest on reserves and other liabilities were eliminated, the Fed would lose control over rates. The stance of monetary policy would no longer be appropriately calibrated to economic conditions and would push the economy away from our employment and price stability goals. To restore rate control, large sales of securities over a short period of time would be needed to shrink our balance sheet and the quantity of reserves in the system. The volume and speed of these sales could strain Treasury market functioning and compromise financial stability. Market participants would need to absorb the sales of Treasury securities and agency MBS, which would put upward pressure on the entire yield curve, raising borrowing costs for the Treasury and private sector. Even after that volatile and disruptive process, the banking system would be less resilient and more vulnerable to liquidity shocks. The bottom line is that our ample reserves regime has proven remarkably effective for implementing monetary policy and supporting economic and financial stability. So I will close with a brief discussion of the economy and the outlook for monetary policy. Although some important government data have been delayed due to the shutdown, we routinely review a wide variety of public and private sector data that have remained available. We also maintain a nationwide network of contacts through the reserve banks who provide valuable insights, which will be summarized in tomorrow's beige book. Based on the data we do have, it's fair to say that the outlook for employment and inflation does not appear to have changed much since our September meeting 4 weeks ago. Data available prior to the shutdown, however, show that growth in economic activity may be on a somewhat firmer trajectory than expected. While the unemployment rate remained low through August, payroll gains have slowed sharply, likely in part due to a decline in labor force growth due to lower immigration and lower labor force participation. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. While official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue their downward trajectories. Meanwhile, 12-month core PCE inflation was 2.9% in August, up slightly from earlier this year, as rising core goods inflation has outpaced continued disinflation in housing services. Available data and surveys continue to show that goods price increases primarily reflect tariffs rather than broader inflationary pressures. Consistent with these effects, near-term inflation expectations have generally increased this year, while most longer-term expectation measures remain aligned with our 2% goal. Rising downside risks to employment have shifted our assessment of the balance of risks. As a result, we judged it appropriate to take another step toward a more neutral policy stance at our September meeting. There is no risk-free path for policy as we navigate the tension between our employment and inflation goals. This challenge was evident in the dispersion of committee participants' projections at the September meeting. And I'll stress again that these projections should be understood as representing a range of potential outcomes whose probabilities evolve as new information informs our meeting-by-meeting approach to policymaking. We'll set policy based on the evolution of the economic outlook and the balance of risks rather than following a predetermined path. And with that, thank you again for this wonderful award and for inviting me here today. I look forward to our discussion. Thank you.
You need your iPad and
No, buddy.
Thank you, Chair Powell, for the excellent remarks in the Adam Smith address. And we will have about half an hour for questions. So
Sounds like a long
should
time.
have talked longer. So let me start with, before I go to some of the questions coming in from the audience, and do use the Connect app to generate those. You have said, and you repeated again here, that there are no risk-free paths for the Fed now. So in light of that, and in particular with where the recent inflation data are running, let me group this with some of the questions that we're seeing coming in on the app as well. Obviously, always data dependent. But thinking about the dual mandate of maximum employment and price stability, how concerned are you that if the rate of pass-through of tariffs is slower, that might begin to look like more persistent inflation, as opposed to a one-time, as if the tariff adjustment came through all at once, and then it would be quite clearly a one-time price level shift?
So that's certainly a risk. As I mentioned, there really isn't a risk-free path now, since it appears that inflation is running above our target and appears to be continuing to increase quite gradually, but increase. It's still on the way up. So there's a risk there that would lend to greater persistence. But now the labor market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So those two states of affairs for our two goal variables, call for different monetary policy responses. So as they come more into balance, I think the idea has been that policy should move from being tight to some degree to being more neutral as those two things balance out. But it is clear, though, that if we move too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. And if we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two things. I think for the last few months, we've been able to maintain a restrictive stance because the labor market was still pretty solid. I think that the data we got right after the July meeting showed that, which adjusted back all the way through May, showed that the labor market has actually softened pretty considerably and puts us in a situation where the two risks are closer to being in balance.
Let's move to the other risk then and talk about employment a little bit. We had Anna Paulson here yesterday, and she spoke about the break-even unemployment or break-even employment growth rate. And that's a question from the audience as well. So I believe she said that it's certainly lower than it was, and the standard error around those estimates probably includes some numbers that might even be negative. where do you see the monthly break-even employment growth rate at this point?
I'm not going to try to give you a pinpoint number, but as you pointed out, the standard error around these things is 50,000 plus or minus, something like that. And that would certainly, I think the range of plausible numbers for the break-even rate is probably does go below zero, accounting for those standard errors. It's clearly come down a great deal. And that's what's so challenging about this is that both supply and demand in the labor market have come down so sharply, so quickly. And the fact that the unemployment rate has barely moved is kind of remarkable in and of itself, and suggests that they're moving at roughly the same pace. Although, of course, the unemployment rate has ticked up, which suggests that demand is moving a little faster than supply. I wouldn't want to point to a specific number other than to say that it's come way down. And there are many estimates out there. By the way, there are many ways to calculate it, so you're going to get different estimates.
We're certainly in a volatile and changing environment. So one question I have is whether you see any changes in the transmission mechanism of monetary policy actions. So when we speak of long and variable lags, as we do, are those changing? And in particular, do you think there might be any difference in the impacts of policy on inflation versus employment? Is one changing more than the other?
That's like 2 or 3 questions, so I might have to come back to you. That's right. So on transmission, there, in theory at least, I see 2 things. One is, what we say and the actions that we take on monetary policy and how quickly that gets into financial markets. So if you go back to when I was in college, that part would have taken, weeks, months probably. Now that part happens essentially instantaneously. But the rest of it, once it's in the financial markets, how quickly does it affect economic activity, unemployment, employment, inflation, et cetera? I think that's more dependent on the conditions in the economy. For example, if you take the group of people who had extremely low rate mortgages, right? And even so, if you can cut rates, but they're a long way down, and they're sort of in a place where it's going to be expensive to take out a much higher rate mortgage, even assuming significant numbers of cuts. So that has probably blunted the transmission of lower rates into that part of the economy. But overall, I think it still works the way we think it works, which is, long and variable lags means a lot of uncertainty about how it's being affected. I think the last part of your question, the lore has been that inflation and employment come later. The first decisions are purchasing decisions, hiring decisions, and things. Well, purchasing decisions, can be affected probably more quickly, but then those would eventually affect employment and inflation. So longer lags are when the research generally shows longer and longer lags for employment and inflation.
And I guess the variable part of that comment does give us a bit of cover.
A lot of uncertainty.
So you spoke about the adjustments or the challenges that you're facing with some government data not currently being published. Beyond the headline unemployment rate, which we're not going to see right away, what other labor market indicators are you monitoring most closely to gauge that side of the mandate?
So I think everyone's looking at the same non-government data. So there's a set of non-government data around, or non-federal government data around labor markets. For example, state level unemployment, claim reports. You can add those up and get a pretty decent estimate, and that's a really good one. There's also ADP has its data and employment. So in the employment space, there's some plausible data. I will say generally the private data, the alternative data that we look at is better used as a supplement for the underlying governmental data, which is the gold standard. And it won't be as effective as the main course as it would have been as a supplement. So we don't expect that we'd be able to replace the data we're not getting. So I think in job, in employment space, there's some pretty good substitutes, less so in inflation space and in economic activity space. And also they're just, there are different private data providers use different universes and different levels of rigor in their data analysis. So, we're looking at lots of things, and we're going to make our decisions according to the FOMC schedule. But I think it will be a lot better once we start getting, for example, the September employment report is going to be a very important report, and we're not on track to have that. There would still be time for us to get that. We will get, of course, the September inflation, the CPI and PPI reports. So that's a positive. But we don't comment on fiscal matters, but from our standpoint, we'll start to miss that data, and particularly the October data. If this goes on for a while, they won't be collecting it, and it could become more challenging.
You used the term gold standard, and you didn't mean it in this context, but I'm going to pivot here because there's a question from the audience that's getting a lot of upvotes. So one of your predecessors, Alan Greenspan, used to view the price of gold as an indicator of inflation risk. So in that context, how do you view the rally that we've seen in gold? And if you want to throw in Bitcoin, you can comment on that too.
I'm not going to comment on any particular asset price, including that one. And I think we think of inflation as driven by fundamental supply and demand factors, and it's not something we look at actively.
Fair. The September projections, we saw revised GDP growth projections revised upward for both 2025 and 2026. Now, sometimes it's just an issue to issue thing, but how do you reconcile that projection of stronger growth with what we're seeing in terms of a likely weakening labor market?
So even subsequent to the September SEP, we've seen economic activity data which are surprising to the upside. And as I mentioned in my remarks, so you do have a bit of a tension there between the labor market data that we see, very low levels of job creation, and yet people are spending. So economic activity is strong, and it's we're going to have to see how that plays out. Right now, of course, we're not getting any new government data on that, any new federal government data on that, but it does create, of course, if economic activity were stronger, then that would tend to support labor market activities and hiring. So we'll have to see how that works out.
Great. Another topic that has permeated the conference over the last 2 days has been AI. So as the Federal Reserve, like all of us, grapple with the implications of generative AI, what plans are in place to assess its long-term impact on productivity, implications for labor markets, and overall economic stability? And does that present any new risks to monetary policy or financial stability?
So you're right. We're doing what other people are doing, which is reading all the things so many researchers are working on AI now. It's just amazing. And so we follow all of that. We also have people at the Fed who are doing lots and lots of research on AI. And, in terms of, it's just such early days to be looking for the kind of things that will happen. So, the question of productivity, it was Robert Solow who said that technology is showing up everywhere, but in the productivity data. So this could be the same kind of thing where it's there, but it takes a long time kind of to show itself, because you would think of another big technological advance as potentially raising productivity, but I think it's early to say that we're seeing it. Also, you're seeing, I think some researchers have found effects on hiring from AI for entry-level people and for coders and things like that. So there's probably some of that out there, but it's just so early to say what it will be. We also monitor very carefully what public companies are saying. Increasingly, bold statements from mainly large private companies on things that they think they can do across their whole business area with AI, and either sort of freeze hiring where it is or reduce hiring. And I think we're pretty aware of what the potential outcomes are, but the range of potential outcomes is very broad. I will say, in terms of what the Fed can do, we deal with supply and demand. We have an interest rate, and we also do regulation, that kind of thing. But if what's needed is greater education and skills. I mean, I've always liked the model that, technology can work for everybody as long as everybody's getting the skills and aptitudes they need to use that technology. This is Golden and Katz, their work, which they actually spoke about at Jackson Hole this year, but it's a 20-year-old book that they wrote. So we can't do that. That's not something the Fed can do. We also can't address the potential societal disruptions that could happen, potentially, if there's really significant job loss. So there are a lot of, we're the least of it. There are potentially really significant implications for people in the labor force. And I think we're all speculating about what those might be, but it's only the beginning of this story.
Yeah. Looking at some of the other questions that are getting upvoted, and you can get as far into the weeds as you want, but this is where people want to go. So let me try this one. As you think of the appropriate level of reserves in the system, what indicators are most important? Is it the price of money, so repo levels, or the volume of borrowings from the Fed, like the discount window, and so on?
So we have a nice spider chart and 5 main indicators, one of which is sort of repo levels. And I think overall what they're showing is that we're still at ample reserves. Abundant reserves. We're still at abundant reserves, meaning above our goal of ample reserves, a little bit above ample reserves. So, but we're beginning to see, you're starting to see a little bit of tightening in money market conditions, particularly repo rates have moved up. And those are the things we're going to be watching. So we think we're still at abundant, and we're, the pace of runoff is now very, very slow. So we're going to be watching all those factors very carefully. And we're not so far away now, but there's a ways to go.
I think we're not going to get away without addressing this one. So I'll try to, again, group some of these together. First, there's definitely appreciation from the audience, your ability to try to remain above the political fray. And I think also, and as in your remarks, you said gradually and predictably, and that sounds really nice right about now. But with that ongoing scrutiny of the policy decisions of the Fed, what measures is the Federal Reserve taking, and are you taking, to ensure and demonstrate the continued independence in setting monetary policy?
So the main thing we can continue to do is to do our work the way we've always done it, which is, think really carefully about evolving economic conditions and the evolving outlook and the balance of risks, and try to make good decisions to best serve, the American public, and then explain those decisions and talk about them in a way that makes sense and is grounded in the data and our overall approach. I think we're going to keep doing that. And as long as we're doing that, people will be able to tell. If we start doing something else, I think people will be able to tell that too. But that's just not something we're ever going to do. We're always going to keep doing our work. We don't engage in back and forth with people. It's just not that gets to be political sort of right away. So we just do our work and do it as best we can. I mean, overall, I would say the Fed comes through the last, if you think about it, go back to the beginning of the global financial crisis. We've had 2 world historical crises back to back, essentially. And the U.S. economy, it's been quite a ride for the U.S. economy and for American citizens, but we've come through it as well or better than any other country in the world. And we had to innovate and did innovate. There was really no choice. We can look back now and as I did today and second guess ourselves, which is only appropriate. That we've been doing it for 10 years. Since I got to the Fed 12 years ago, we were already doing a lot of that. So that's an ongoing process. But I think if you take a step back, the Fed is a government agency that does a good job for the public that it serves, and that is our only goal. And I think we do it pretty well. Don't look for perfection. These are close calls that have to be made in real time. But I guess that's what I would say.
It's fantastic. And in that context, then internally to the FOMC, how important is it that you have consensus on it? I mean, we're economists. We understand the value of spirited debate and But is that important in terms of communicating the results and the decisions of the committee?
I mean, consensus is great, but I mean, the most important thing of all is to get it right. And, you know, that you come to places, not very commonly, but sometimes you come to places where people are going to have different views. And this is one of them. You have a situation here where literally inflation's above target and gently rising. The labor market is subject to pretty clear downside risks. What do you do? How do you think about that? That's not a problem that you face very often in central banking or in the economy. And people are going to have different weights and different risk aversion and different risk appetites on those things. It would be kind of surprising if you had no debate over those things. So we have a healthy debate going on. I think it's very healthy. I think the meetings that we've been having are as good as any we've had, you know, in terms of people sincerely, you know, giving their absolute best argument for their positions, but they're different positions. That's, I mean, when I was an investor, I always felt like the most dangerous thing is if everybody agreed on something, because you need someone to come in and try to explain why this is a terrible idea. Hopefully somebody really smart. And that would give you the ability to really test your thinking. So I think that's a healthy discussion that we're having right now. And I'm not at all surprised that we have people across the board. I do think we also, as an institution, do try to come together around you know, a central answer. And that's, of course, part of what I try to do is you know, find an answer that will attract as much support as possible.
Absolutely. I know you probably won't want to comment in great detail on global conditions, but there are a few questions around that and what that implies for U.S. monetary policy, and also just looking at the interest rate differentials between the U.S. and other advanced economies, and how long that could persist, and is there a risk there?
Sorry,
the interest rate differentials between the U.S. and other advanced economies.
Yeah, I mean, you know, we set interest rates according to, you know, the place where our economy is domestically, you know, taking into account the international aspects of our economy. So again, it's not surprising. I mean, you could name many factors, but, you know, for example, tariffs are clearly more disinflationary for countries that are subjected to them, and they're more, I won't say heavily inflationary, but there's some inflationary pass-through to consumers from countries that are putting tariffs on. So there's a very different monetary policy response potentially just in that. So, you know, I think we need to set, as every other central bank does, they're setting rates in their, whatever their, you know, remit is geographically, and they're going to be different answers. It's not unusual.
So we have a large number of young economists in the audience today. Could you talk a little bit about, as we look back, and, you know, it's a momentous award, it's a nice time to reflect. If you looked back on your early career and your early goals, how do you think that young Jerome Powell would view where Jerome Powell is sitting today as chair of the Federal Reserve?
Surprised. No, I would say, so what I would tell young economists is you've chosen a great profession, a tremendous profession. You know, you're getting the tools to analyze public policy and what works and what doesn't work and what should be expected to work and why. And also what's the state of the economy. And guess what? It's not just hard, it's basically impossible, but it's a very, very difficult thing, but it yields itself up over time. And, you know, it's just an incredibly important subject that carries the capability to do really good things for the general public, who may not feel great gratitude toward economists, but sometimes. But no, it's really important. You've made a great choice, and I would say wish you the best of luck.
Thank you. Agree. Okay, we'll do a little bit of a lightning round here. We have about 5 minutes left, so I'll ask a bunch of questions that you may not want to get into great detail on anyway. Some of these are pretty straightforward, but so we talked quite a bit about labor markets, but we have not specifically asked the question about the effect of immigration policies on labor supply. How restrictive do you think that current policy is? And is that something that will just
Current immigration policy?
Yeah.
Yes. Let me start by saying that we don't have a view on immigration. It's not our job to have a view. So we take that as completely, it is what it is. We take it as it arrives. More, I'd say, stronger policy than most people had expected. We've seen very sharp decline in growth of the labor force and in people entering the country, and yeah, I think you're only beginning to see the strength of that policy too. There's more expulsions; those are rising, and that kind of thing. So yeah, that's a big economic factor. So that will mean fewer people to work. You have anecdotal evidence of industries that are just having a hard time finding people. You don't see it in wages or anything like that at this point. You don't see, at least in the aggregate, you don't. But yeah, it's going to be a really important economic fact because that's new people who come into the workforce. They create their supply, but they also create demand. They create their own demand, and again, from our standpoint, we're just, our job is to achieve maximum employment or maximum sustainable employment. And that will depend both on the supply of workers and the demand for workers.
Back to the balance sheet, some questions. Again, I'll kind of try to group these together around mortgage-backed securities and housing affordability. Again, not directly part of the dual mandate, but would the Fed ever look at any specific actions with regard to MBS to address mortgage rates or affordability for housing?
The answer is, look, we look at overall inflation and we don't target housing prices. And also I don't know how you would, we would certainly not engage in mortgage-backed security purchases as a way of addressing mortgage rates or housing directly. That's not what we do. We do have, as I mentioned, a very large amount of mortgage-backed securities, and they're running off, but they run off pretty slowly.
Fair. Question on the beverage curve. Maybe that's not a lightning round question, but let's try it. So do you think that the shift in the beverage curve is a structural shift or just a blip?
I think it's, you're at a place where, further declines in job openings might very well start to show up in unemployment. You've had this amazing time where you came straight down, and but I just think you're going to reach a point at which unemployment starts to go up, and we haven't really. We may be hitting that now, but it's been remarkable how that line it just comes down, and which has been really a great part of the recovery.
All right. Well, we have just a couple minutes left. I think we'll end with maybe another sort of philosophical question. Michael Barr spoke to the policy conference in 2024, I believe it was, and he gave some advice to economists. What would your advice be to the economists in the room in terms of how we can best serve the challenges that are facing us collectively in this moment?
I'm inclined to say keep your heads up. It's a time when people are challenging expertise, and I think it's a distinguished profession. It's a very high order profession, and you should be proud of your work and keep at it. Ultimately, we're learning about how the economy works and how society works. Our understanding is so basic and so uncertain, really, still after all these years. But you got to think we're making some progress and doing some good, and imposing sort of an analytical framework around the kind of decisions people make about the economy. So I just want to give you a vote of support and say keep at it.
And likewise, NABE supports you.
Are we done?
We're done. Thank you so much.
Thank you. Thank you very much.
Well, there you go. All good. Gonna be honest, not a lot of, I thought it was an interesting conversation, but not a lot of urgent matters from Powell in regards to today's world. Kind of mentioned what we already know in terms of the posture of the Fed, which I would best describe as still geared towards they believe it is restrictive. The next path for the Fed is to continue to normalize, which means cutting rates because, again, they've kind of been more administered towards the inflation side of their dual mandate, and dual mandate being keeping jobs strong as well as inflation under control. It seems like in recent times they've moved more towards administering to both, which means cutting interest rates from where they currently see as restrictive. So I don't think we saw or heard anything there that was dramatically different than we were expected. There was one comment about how tariffs are expected to be a pass-through effect on the, or potentially a price increase on the consumer, but that the longer term expectations for inflation are still in line with what the Fed is looking at. Was there anything else, Chris, that you saw that was interesting? Oh, I think you're muted. Yep.
I was echo.
Oh, can you hear yourself?
Yeah.
Oh, sorry. 1 second. Try that.
Okay. I was just listening and watching price action. The fact that we are way above the expected move for the day, the fact that the market's ripped almost 1.6% off the lows today, it's just a little offensive. 1.9%, Nick, off the lows today.
Look at that.
Literally
VIX
tested
drop,
Friday.
right?
I mean, just stupid, man. The VIX is just dumping. And like I told Nick and I were talking offline, I just said that looking at some of these days where it's like the actual upside risk in this market is insane. Like literally the market is melting up today beyond what the VIX was measuring this morning. I mean, I do this stuff every single day, and I was looking at the VIX at 21. We're like, all right, a 1.34% move today, calculated out. That should be pretty much containing price. Even from the open today, the market has gone up exactly 1.34. So if I'm right with my calculation this morning, we hit exactly the VIX box level around 1.34. We shouldn't see price closing higher than 66.78 today. We shouldn't, if the market makers are going to do their job, we shouldn't see prices closing higher. Now, the fact that the market ripped off of Friday's lows, you know, we opened this morning with a huge gap lower, tested lows, ripping back up. We took out Monday's highs. It just kind of puts us right back in limbo with like what's happening this week. We didn't take out the lows. We're not taking out the highs. We're right back in the middle. There's still some drama to unfold for the rest of the week. We have no data to go off of, right? Fed is still obviously lined up with a super high probability of rate cutting October and December. So all we have to go on for the rest of the week is what? No inflation data, no job numbers, no buybacks in stocks. It's like, it's just, I think it's simply manipulation, man.
The Russell recaptured everything.
Wow.
That's great.
Good for the Russell. Dude, good for the Russell.
The Russell recaptured the whole move from Friday. I mean, SPX, this is from peak to trough. It's done a little bit more than, let's call it 65%. But to see 100% of the losses recaptured just from Friday is a pretty incredible rally for the Russell.
Wow.
Maybe that suggests yields are lower here today. Let's just see if that is correct. Yeah, yields are, I mean, that's kind of interesting too. We're in this operating blind environment, and yet yields are making the most directional move they've made in a while, which is interesting to me because it's like you don't have the jobs data. You don't have a lot of data is missing from the government shutdown. And yet here is the default move is yields lower, expectations for rate cuts are increasing. And with that, gold is up to 41.50. We just narrowly missed 4,200 an ounce here today. It's a weird market, man. It's like you just get, there's just no pullbacks in the precious metals world. The stock market, I mean, to see the complete 180 like that is just crazy. Such a such short order.
I mean, it is what it is. I think it's days like this that bother me that I trade so actively every single day because, you know, there's no framework for the market moving when, market makers have done this for 50 plus years, and it's expected moves are greater than the actual. We have a high VIX at 20 plus. We should be able to see that the expected move is greater than the actual. And the fact is today, it's not. It's the actual is greater than expected. And in a same day environment, that is super frustrating. Even in
That
the
is
high
super
VIX,
frustrating because you're having
VIX.
exceeding the expected move while the VIX is falling too. Like you would, my
Exactly.
guess would be if you told me like, okay, we're going to exceed the expected move, I'd expect the VIX to be up.
Right.
And that's the strange it's like
it's not happening.
Beyond expected move by the market rallying, which is
it's literally upside risk.
Yeah.
Which doesn't really apply. I'm not saying that's oxymoronic, because clearly the market melt up has been what we've been seeing since the bottom in April, but do not fight this market. It's just what we are dealing with. And okay, so we had a 2.5% sell off. The candle was high to low about 3.3%. Enough of a cleanse, enough of a spike in the VIX. That's the aggressive reset. It is what it is, man. The market's going to settle in here in the next couple hours. I'll figure out if I survive the day. Key levels for me, I need price to get back below 66.71 or 66.70 to kind of survive. I'd like it to survive back below 66.35 if we can have the market kind of go, down for the day all the way up here with a pretty big rally and then settle maybe back in around equilibrium. That would be ideal. But given this market, we're back into positive gamma for the day, and I just think that it's just going to sit here and kind of elevate around these levels. Now, I did put in a trade just now to see if I can hedge out. I've got a trade that cost me 65 cents of max risk for potentially $935 of profit. If we continue to see this melt up, Nick, I've got a level where my 50% ATR is 6,700. So if the S&P today can climb up to 6,700, I've got a pretty good chance of making $500-600 during the day, and maybe if it is close to settlement at the end of the day, then maybe closer to like $800-900. So it might still help me win the day or survive the day and wash out some of the risk. But again, just kind of a silly thing to like follow a process, have a plan, use the VIX extremes, and still be caught on the wrong side of that move. It's like
very strange.
Hey, man, risk the upside's nuts.
It's one of those things. It's frustrating, but it's probably like you repeat that trade 1,000 days in a row, like you're probably going to do well. It's just those annoying days where you just get these strange.
It's 1 out of 10. It's like 1 out of 10 times it'll annoy me because I, follow the plan and generally win about 90% of the trades. So it's a one offer, but it's so frustrating when it does happen because even with we've been waiting for higher volatility, waiting for a pullback, and we get it, and it's like this market will not follow through on anything to the downside.
Just drift up. Do you do anything with the banks, Chris? Wells Fargo's up 8%. You have JP Morgan. JP Morgan was down 4% this morning. I thought that was actually going to be part of the reason we could get a little bit further downside today. And then not at all. JP Morgan ripping back higher. I mean, that's the biggest bank in the world. So I was thinking, hey, that might be our indicator. Because going into this week, guys, we've been in the blind with a lot of economic data. The banks are really interesting because you want to talk about the most toned in companies to the US economy or to the global economy. Look no further than the banks, because the banks are loaning money to people in this economy. They know what people's savings look like. They know what their direct deposits, they know everything about the consumer. The consumer's the lifeblood, right? So, banks, my thought process would be like, we're in a blind period. Bank earnings are going to be even more interesting than usual. I guess offset a little bit by Wells Fargo up 7.7% here today. And then, I would argue that the comments from the Fed were kind of a nothing burger. So I'm not exactly sure where the rally's coming from. Maybe there was a tweet that we're missing or something.
Yeah, I'm not sure. I mean, were there earnings today, or is it just a rip on?
JP Morgan had earnings this morning.
Yeah. I mean, financials lead the way for earnings. We're just kind of kicking off this earnings season with financials and big banks this week. I think this is just kind of reassuring that there's financial health and stability. And if they do that and they're somewhat positive on guidance and somewhat positive on Fed cutting rates shouldn't be super bullish for banks, but what they're looking to do is deregulate all of the restrictions and, bond durations and things where basically they will have more flexibility in how they can lend and position and not be stuck with just like holding a bloated balance sheet of, maybe having that duration exposure like we saw back in 2023 with the regional banks. So if they're deregulating banks, that's going to open up the doors for them to lend more, leverage more. And, that might come back to bite us in the butt like it did in 2007, 2008, when they were completely irresponsible with subprime. But if it's just healthy balance sheets, things are looking good, economy's fine, people are still spending, borrowing, blah, 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 and they're just greasing the wheels, then I mean, banks are probably a good primer for solid earnings coming in the next few weeks.
Yep. We'll have to see. We'll keep an eye on it. Chris, I think we're going to wrap it up there. Thanks for hanging with me here, taking a
Of course, man.
listening to the Fed. Of course, another day in this crazy marketplace. If you guys want more content from us, make sure to subscribe wherever you're watching, follow wherever you're watching. You can also find Chris Pulver on his own YouTube channel if you want to check him out. We'll leave the links in the chat here. You can just search him up on YouTube or socials. Just search up Chris Pulver. You can find out more information from him. And if you guys want to get access to the trade alerts that we're sharing, here is how. Send a direct message to our support staff here at A1 Trading. We'll, again, drop a link in the chat, or maybe we'll change the QR code at the top of the screen if you don't mind. That would make it so that you can just scan the QR code, let us know you're interested in getting access to our signals. You can get access to every trade that we are taking. Chris and I combined experience, I guess we've got 30 plus years combined experience, sharing everything we're doing, live markets, live accounts, all that good stuff, broker logins, all the good things. If you're looking for real trading and joining a community that is all about transparency, come join us at A1 Trading. Send us a direct message here if you're interested in getting access to Chris Pulver's alerts or our VIP signals as well. And we'll get you in the group. See you guys in there, and see you later, Chris.
Take care, Nick. See ya.
You've been watching A1 Trading Live. We're here Monday through Friday, where you can tune in to hear insights from professional traders from all over the world. Make sure to subscribe for future streams. And as a reminder, if you're looking to get access to free courses, prop firm discounts, and free trading tools, head over to a1trading.com. See you next time.